Good morning everyone and welcome along to the Fat Profits Research webinar for this Thursday, the 11th of December. My name is Kai Lewis, I'm one of the equities analysts on the floor, and joining us this morning will be David Lennox, the head of resources. So we'll get things underway and we will be concentrating on oil this morning. Obviously a lot of news out around the oil sector and the companies involved. Firstly, a brief recap of what happened in the markets overnight. So yesterday the ASX 200 closed at 52.95, down 24 points. Overnight gold was down about $5 to 12.26 US an ounce, so fairly flat. And the Dow Jones took quite a hit, down to 17,533 points, which was a drop of 1.51% or 268 points. So quite a drop there, and most of that is on the back of what's happening in the energy sector, giving Wall Street the spooks. So we'll get things underway and we'll take a look at oil. First things first, good morning, David.
Good morning, Kai, and welcome back, and good morning, members.
All right, so David, obviously a lot of news in the oil sector. So first of all, we'll take a look at the oil price, and it really does tell the story, this chart. Can you tell us a bit more about what it means?
Members, look, we just want to, I think, put what we're seeing in the oil market into some form of context. And really when you do that, you've got to have a look at the longer term rather than these very short-term movements that we see in the price, which tends to influence people's thinking. What you've got in front of you there, members, is a very long-term chart of the WTI, or West Texas Intermediate. And as you can see, even though oil now is trading somewhere in the low $60 a barrel range, it is still significantly higher than where it was now only some 20 odd years ago. And we really do think, when you have a look at the long-term trend that we've seen in crude prices, and if you threw a trend line across that data that's in that graph in front of you, it would continue to show that oil is in a very strong upward trend in terms of its pricing. So we think that when you have a look at the longer term factors that have been influencing and playing out on the oil markets over the last 20 or 30 years, they still certainly remain in place. Yes, as you can see from that chart in front of you, we do see very short-term volatility in the oil price, and as that data is certainly not a smooth line. That data line, sorry, is certainly not a smooth line. And we think that that's certainly going to continue playing out in the months and weeks and even the years ahead. But we are certainly of the view that that trend will remain intact, and we will continue to see oil price on a longer term upward growth. Certainly if you were a holder of oil, you know, back in the mid 80s or even as early as 2000, you'd be very comfortable with the price where you're seeing it at the moment. So look, overall, members, let's put what we're seeing in the short term into some form of longer term context, and from that point of view it looks very sound still.
So you'd have to say, David, that obviously we've seen this all before. I mean, it's obviously never nice to be at the trough or down when prices are sliding, but everyone, fair to say, we have seen this sort of thing before, and it will bounce back as it always does. And if we take a look at the oil demand in the next slide here, so we'll flick over here and just have a look. The oil demand, it's remained fairly resilient across the major economic superpowers, America, China and Europe.
Yes, members, look, they're the three biggest consumers of petroleum product in the world. Obviously, the US is the biggest single consumer, China's the second, and Europe as a group is the second largest behind the US. And what you've got in front of you, members, is, and we've been watching this particular demand for 2014 unfolding, and now we're nearly towards the end of the year. We've not been surprised by the fact that we've seen relatively stable demand going forward. We've seen very sound growth in the US, and even though we've seen slowing growth in China, we've seen their demand for energy remain relatively stable. And even though Europe unfortunately has been an economic mess for some time, their actual demand for petroleum product has remained relatively stable. And we think that going forward, with the three big key users of petroleum product really showing stable demand, that's certainly going to produce or maintain or actually keep a very good floor under the oil price. And we think going forward, once we do start to see perhaps a more coordinated economic growth across the globe, that we will start to see a greater surge in demand. And of course, with that, if the oil price turns anywhere in the $60 barrel range, we could see it run to new records a lot higher than it has in previous peaks. So look, overall, members, we've been watching demand through 2014. We've been very comfortable with what we've been seeing, but it really hasn't been the demand side story at this point that's really playing out in the oil price at the moment.
And if we take a look at the latest EIA numbers as well, and we see the US inventories, they are on the climb again. Can you explain a bit about what this means for the wider oil price there, Dave?
Members, what you've got in front of you is the US inventory numbers, and the last weekly report that came out just overnight showed that there was a further build in US inventory stocks of about 1.5 million barrels. That followed from the week before, where we saw nearly 4 million barrels taken out of inventory. So what we're seeing is perhaps just a little bit of softness in terms of US inventories, but really what we saw was that the US actually imported cheap oil from its competitors in actual fact, and that was really the main reason why we did see this build in inventories. If you have a look at the US itself, we are at the moment seeing US refining companies actually at the moment operating at somewhere around nearly 96%, so they're nearly flat out. In fact, in economic terms, they are in fact going flat out. And we do think that that underlying actual operational factors that we're seeing do point to a continuing strong underlying demand in the US for gasoline. And again, that's certainly going to, we believe, through 2015 point to stronger oil prices as we go forward. But as I said for the previous slide, it's really not a demand side story that we're seeing playing out in the oil price at the moment.
And if we switch to the next slide, which tells us a bit about the underlying cause of the malaise in the oil price and what's happening with the oil price recently, it really does come down to that US crude oil production in the United States across the shale areas there, doesn't it, David? I mean, they've just kicked it up, the biggest rise in the last 30 years, and it's coming from America's shale revolution.
Members, yeah, look, we've shown you this graph on a few occasions now while we've watched the oil price, unfortunately, go through its throes. Yes, you can see very clearly from that chart, and we've probably never really seen anything like this since probably the 50s, when certainly the countries in the Middle East started really pushing oil production. We've never seen really anything like this shale phenomena that we've seen in the US over the last year and a half. You can see completely at the end of 2010-11, there was a complete reversal in the trend of US domestic production. And we think going forward that that production will perhaps just tip over a little bit and will slow, but we will continue to see US oil companies pushing through new shale production. So this is why we've been saying all along that it's really not a demand side story that we've seen that's impacted on the oil price. It's really this supply side. And this is where we think we will see some significant improvements in 2015, because members, all it will take is for a key producing nation or OPEC as a key producing cartel to actually come in and suggest that they will start to cut production, and we will very quickly start to see the oil price stabilize, and then dependent on the depth of those cuts, perhaps even reverse the recent trends. So this is one of the key reasons why we've always remained very comfortable with the energy sector. Yes, it is subject, like every other commodity, to price cycles, and it would be naive of me to say that oil will go up forever. And as the chart you saw a few charts earlier, or the slide you saw a few charts earlier, indicated that oil's just as volatile as any other commodity. However, there's not a big player like OPEC sitting in the copper market or in the gold market. And it's this particular key factor that we think will certainly through 2015 play a major role on where the prices are going. If OPEC or a major player such as Russia or now the US don't step up and cut production, then members, I could suggest to you that we will certainly see more pressure on the oil side on the downside. If we are right and one of those particular players does step up to the market and does start to cut production through 2015, then members will start to see a much better oil price as a result of that. So our reason for staying in the oil market and remaining very comfortable with the oil market, not only now but in the longer term, is A, because we think the trend long term still remains quite intact, and B, we think that there are certainly significant and limited number of players that can have a major influence on where the oil price will go in the future. So the shale boom, it's with us now. It's certainly not going to go away, and there's the potential for other regions, even such as Europe, which has major shale resources. They're just not using them. We could see all of this repeat itself if Europe decided to go down the shale revolution as well. So members, let's watch this space, but we'll certainly remain comfortable with the energy sector both now and going into the future.